pandemic experience has reshaped the economy and the workforce, and the challenges and opportunities that we will face during the transition to the post pandemic economy. So, with that, let me turn to our first set of panelists who bring with them direct knowledge and experience of how the economic landscape is evolving for US businesses. They represent organizations that include small businesses, manufacturing, supply chain management, and the hospitality industry. I know that all of you have experienced firsthand the extreme economic and financial hardships brought on by the pandemic. And during the economic recovery that has followed, you've likely also seen rapid and substantial changes in supply and demand conditions in your industries and in the communities where you live and work. Given those lived experiences as business leaders, we are especially looking forward to hearing each of your perspectives. And as we hear from each of you, I'd like to invite my colleagues to follow up with any questions that they may have. So let's start with our first panelist. I'll introduce Tom Henning. Tom, thank you so much for being here with us today. Tom is the CEO of Cashway Distributing, a wholesale distributor of food products for convenience stores and food service establishments in the Midwest and the Great Plains region. Cashway began in 1934, delivering candy to local grocery stores in Kearney, Nebraska, and the company now manages an inventory of over 20,000 products. Cashway has remained privately held by the Henning family, with the second and third generation family members involved in the business today. So Tom, for our first question, could you please describe how the pandemic changed the demand for transportation and warehouse services? And to what extent are shortages of material and labor still affecting your business and industry?
Thank you. The pandemic changed demand for transportation and logistics services in some manners that were expected and some that were unexpected. After the pandemic, we expected a fair amount of pent-up demand that would be released, and it was. In fact, probably the demand that existed out there was greater than what it was pre-pandemic. But what wasn't expected next, before the pandemic hit, was the demand for workers would exceed the supply by a larger margin than what existed pre-pandemic. The size of the workforce became much smaller than it was pre-pandemic. We also believe that many left the workforce, and for a variety of reasons. And we were wrong on that too. We really thought the workforce would grow. There was a shortage of truck drivers and warehouse workers prior to the pandemic, which the pandemic further exacerbated. The shortage of truck drivers before the pandemic was estimated at 61,000 drivers. Today, the estimated shortage is in excess of 80,000 drivers. The shortage of drivers was an issue then, and it'll be a much bigger issue now. And the prediction is it will be an issue in the future. We've seen some estimates that the shortage will double by the year 2020. And to give you an idea of the size of the driving force that is out there, the universe of truck drivers today is 1.53 million drivers. So you take, a 5% shortage, a 6-7% shortage. I mean, it's going to be significant out there. As a result, the cost of labor has increased significantly for everyone in the supply chain. With the supply of labor down, the competition for drivers heated up immensely. There was an extreme amount of pressure on the transportation and logistics side, and still is, and probably will continue to be for the foreseeable future. In order to attract and retain drivers, our company raised our wage rate 3 times in 2022 so far. In 2019, we gave all our employees free health care. And then we gave all our drivers and warehouse workers retention bonuses. If they stayed with us to the end of the year, they would get a bonus paid out on the 30th of January. and that did much to solidify the workforce. Then there were the supply chain issues, and the shortages of products we sell every day from our supply chain vendors was significant and still exists at a high degree today. Prior to the pandemic, and we measure our inbound fill rates from our vendors every week. We have a number of metrics that we utilize every week. Our inbound fill rate from our vendors was 99.2%. So for every 100 items that we would get in or we would order, we'd get 99.2 in. Our inbound fill rates right after the pandemic started dropped down to about 55, 60%. By December of 2020, it was up to 90%. And in 2021, we had a pretty good start, and then it dropped to 78 to 80%. And this year, it was probably in the 80% range, 82% range. And for the last 10 weeks, it has been running 90%, which is good news. We changed our inventory philosophies because we had many customers out there that depended on us for products. So we started loading up our inventories. We used the popular inventory philosophy of JIT, just in time. And then we changed it to JIC, which is just in case. So we're over inventory, but those people need products. A restaurant who has got an event planned for Friday night and you make a delivery Thursday and the product isn't there, he's in trouble. And it's all, our business is all about customer service. As a rule today, most of the time, we don't know what we're going to receive from the vendor, and which is kind of unusual. There are many challenges for the vendor community out there. A lot of it has to do with raw materials. They have labor problems also. They've got priorities on certain lines that they're producing. And so anyway, most of the time, we don't know what we're not going to get until the truck unloads, or we might have a call from that vendor, which is a switch from the norm. And the timing of deliveries is probably not as great as it was pre-pandemic. Since the pandemic began, our vendors have eliminated over 900 items that we no longer have. And especially in the convenience line, that's where we really notice it. You know, between wages, worker shortages, the price of fuel, and the supply chain challenges, our costs have really skyrocketed. We believe and have gone through our numbers and look at the inflation numbers. We look at our inbound freight rates, understanding that we get probably our products from growers, from shippers, from manufacturers. So they have freight into their establishments, and their freight costs have increased. We have got freight from their establishments to our warehouse, and then we've got charges, freight charges basically, that are built into our pricing to our customers. And we've been trying to calculate what percentage of the food inflation is relative to transportation and logistics. And we've got kind of a consensus between all of us that probably 38 to 45% of the food inflation that we're feeling right now is because of logistics and transportation. It could be greater. It could be greater than that. We do a cost index report on our total product mix, and we do that every week. We started doing that about 25 years ago, and because obviously you've got to have growth, and you've got to have organic growth, and the difference between the growth you're realizing every week and inflation is basically organic growth. So our cost index report, and I've got numbers from, I think, since 2020, indicate where we've been, the path we've been on. This last week, our inflation rate was probably the lowest it's been in, I'm going to guess, probably 4 or 5 months. It was down to 10.3%. But yet, compare that to what the inflation rate was the same week a year prior. Our total inflation from 2021 is probably 22, 23%, in that range. So we're seeing some drop there along the line. We're also seeing some softness in the marketplace, which probably is indicative of why the inflation rate is lower. On the other side of the coin, we still have increases coming through. We're still struggling with product shortages and labor. Product shortages are occurring for a variety of reasons. One of the big factors that's going to have an impact on inflation, probably yet this year and probably next year, is the drought we've been experiencing. I can tell you right now, and we hear this from the potato growers, we've seen the price on what we call Baker's potatoes double in the last couple of weeks. And this last year, the potato growers in the Idaho area, which is really the prime country for growing the kind of potatoes of a food service establishment likes to have, they knew they weren't going to get water. So instead of planting potatoes, they planted wheat. And so now there's going to be plenty of wheat that comes out of there, but the potatoes are going to be thin. There's an extreme drought that's hit in California. And California is a big producer of food that we consume. One of the products we're not going to have this year is going to be pears. I remember in 2012 when the drought hit, and we sell a large number of school districts, we imported fruit mix. We imported peaches from Israel. And Israel has, and that was probably the only place, some of those products were available. So we may be in that same boat here down the road. Tomatoes are a little bit on short supply. The other thing that's happening, we're in the corn belt of the country, along with Iowa and Illinois, and we've had a lot of drought there. We're finally starting to get some rain. One of the things that happened last year, and you read about this and you heard about it, because of the war in Ukraine, the price of fertilizer, nitrogen, potash, and phosphorus just went off the charts. Nitrogen went from like $200 a ton up to $930. I know for a fact there were many farmers out there that were doing a balancing act. How much less of this can we use and still grow a crop? And what does that add to my costs? So my guess is going to be that we might find our production of maybe corn and soybeans maybe down a little bit this year. And depending on what happens next year and the experience factors they've got there may, have an impact on whatever some of the commodity prices are. The beautiful part in our area of the country is the cattle market is good, and we're starting to get a little bit of rain now. But if you look around the world, you go into South America, you go into China, you go into Europe, and it seems like every continent is having their share of drought. And so this might be a factor all in the future for food production, and especially the near future. That's just a personal opinion. Labor is still an issue. The driver pool is still far from being adequate. We have a driving force of 250 individuals, and we have positions we work to fill every week. There was a time during the pandemic we were short 20 and 30 drivers. We have one supervisor for every 10 drivers, and they drove all year. They drove vacation routes, time off for other drivers, and the like. Sorry about that. I forgot to turn that off. if I can find it.
All been there.
Sorry about that.
No problem.
Interesting ringtone. Uh,
Maybe to our second question, which is about what your business outlook for next year.
I was just going to get into that.
Okay, great. And what other challenging issues might be facing and expecting to face?
You know, our business outlook for next year is good. I wouldn't say it's great. First off, we sell commodities. Our company was founded in 1934, and that was during tough times. It was founded in 1934, and the products we sell are really, in a sense, recession-proof. People have got to eat, so we're looking for probably a fairly decent year. On the other side of the coin, there's going to be casualties in the marketplace, and we could have some short-term challenges out there. And the way we're dealing with that is interesting. We're working programs right now to keep our customers profitable, and we're reaching out there because I mean they're the lifeblood of the organization. And I think during the recession in the '80s, there were a lot of folks that didn't have a lifeline. Communication wasn't great, so we're reaching out to those folks now. We need to see them through this thing. And it's not a matter of extending them more credit. It's not a matter of giving them some type of stimulus along the line. It's helping them better manage their business, make it more profitable. So that's going to be one of the challenging issues we have. The other challenging issue we really have, and this is critical, I think there's I can't tell you exactly, there's over 2 billion trucks in this country. We have not been able to upgrade our rolling stock, stock for probably 2 years. We have 250 tractors. We have 400 trailers that we need to make the deliveries. We haven't been able to acquire a new tractor since November of 2019. We typically replace 10% of our fleet every year. The last tractors that we purchased in November of 2019 cost $106,000, and it's pretty much a standard product that we buy. Got 5 coming next week. They're $165,000 a tractor, 40% increase. Plus, we've got to pick slots now. We're guaranteed kind of halfway of having probably 20 tractors. We really need 50. We're guaranteed to have 20 tractors in 2023. So we're gonna spend probably 5, 6, 7 years getting things caught up in our fleet. The cost of putting trucks on the road today is very significant. It's gone up right around $80,000. So that's going to have an impact on transportation total. And when you look at the number of trucks in the country, and the options aren't great. We had a number of trucks sit this last year for 7, 8 days because we didn't have microchips. They were 2017, 18 models. The parts availability, tires is one big thing. On trailers, insulation. We had trailers we ordered 2 years ago that we finally got in the first part of this year. Those went up 40%. So 40% sounds like probably an average cost increase that we're going to see with rolling stock for any operation out there. So I think I'm getting down to the end.
Tell me, how does that inflation and cost for these necessary replacement items, how does that impact your outlook for going forward, or changes to how you prioritize expenses in other areas?
One thing about it, you got to have the cash flow to do it. And you've got to have, so that will be the challenge in, developing a plan, a business plan, which which we will do. I think in our company is sound and solid. I don't see a problem there. But I do look at other companies in the industry, and I think they will have some challenges there along that line. And there's some options out there that they can certainly use. But it's going to be a challenge. We spend more money today on just maintenance. A vehicle gets so old and you have a problem. The other thing we need to do that's going to be important is we need to get the manufacturing of a lot of those component parts back here in this country. And I could give you a list of things that we have to source outside of our country that put us really in somewhat of a predicament when it comes to keeping your trucks on the road.
Thank you. We'll probably follow up with you to learn a little bit more about that. But I'd like to ask my colleagues if they have a question.
Yeah, just a couple, one narrow, one broad. The first question is, are you able to pass these costs along? You obviously have been hit by, costs right across the board. And the second thing is really, do you feel like we're getting through this process? That there was enormous disruption to your business and many others, and all these cost increases and shortages and everything. Do you feel like, and I guess there's not that much progress with the drivers, but do you feel like we're getting back to a better place with the suppliers and the customers yet? Or is there a sense of progress?
I think there is a sense of progress. We're making the move, and I think the moves you make are extremely important. And I think that'll get us in the right direction. And applaud you for it. I do think that we're moving maybe a little faster than what I thought in terms of the economy and everything. So no, I'm confident we're going to get there. We might be, the only thing I'm not confident in, I remember when the pandemic hit us, they said, in 30, 45, or 60 days, things will be back to normal. I think what we're encountering right now is going to take a period of normalcy. It's going to be probably 2-3 years off, 4 years off, maybe. We've got to get caught up. It's not going to happen overnight.
And on costs, you've been able to pass those right along?
Yeah, we have. Yeah. And the dollars we work with are large enough. And the customers really don't have a choice. They don't have a choice. We can't lock in old pricing unless they've got contracts somewhere out there. We can't lock that in. And so they end up having to pay it. They're so voluminous right now that part of the problem is you don't know what the cost is. If you ask me what the cost of eggs were, I could tell you probably in a few minutes because someone just told me what they were paying here a little bit ago. But, it's fast and furious.
So despite the higher prices, demand is still there.
Demand is still there. And I suppose it's a question of the amount of money that is still floating out there, in the economy. The bad thing is it's going to be the lower income people that really take a beating. And anyone that's in production, if they're in sales, if they're in manufacturing, whatever the case is, their salaries have kept up, drivers and everything. But we've got a layer of people out there that haven't had a lot of opportunities for increases. In fact, right now, one of the things we are doing is taking everyone that hasn't had an increase and figure out how we can give them one, and how we can give them one that's substantial enough. So that's going to be a challenge probably for everyone down the road.
Thank you very much, Tom. We appreciate your perspectives, and we'll move on then to our second panelist, Chidi Kumar. Chidi is the chef and owner of Garland, a restaurant and performing arts space in Raleigh, North Carolina. Chidi's a self-taught cook who studied recipes while pursuing a career as a guitarist in several rock bands. She was a semifinalist for the James Beard Awards Best Chef in the Southeast from 2017 to 2019 and was a finalist for the award in each of the past 2 years. Chidi participated in our board Fed Listens event last year, and where she shared compelling stories about the challenges that she faced running a restaurant business during the pandemic and in the early recovery period. Chidi, thanks so much for being here with us in person this year so we could actually meet you face to face, so that you can share also your perspectives on how things have changed since last year. So our first question for you is about how your business has changed actually since we spoke last year. How does customer demand now compare to what it looked like before the pandemic? And have you seen changes in dining patterns that you think could be long lasting?
Thank you, Governor Broman, and thank you for having me back. It's a pleasure to be here. So our restaurant, music venue, bar complex is one building that we have been paying rent on since 2010, and we closed our doors at the end of August. So, there were many factors leading to that decision, and most of them are really, I want to say at the outset that I'm a restaurant owner, I'm a chef, and we're working on a new project. I am speaking from my perspective as an independent restaurant owner. Restaurants are ubiquitous. You can eat at a fast food chain, you can eat at a fine dining chain that's in airports and hotels all over the country. Their perspective is going to be very different than mine. And I almost wish that we had a different name for our sector of the industry, because our challenges are unique and the way we approach those challenges are very different, because the math is very different. So for us, so many factors led us to decide to close our doors. And the main thing is that dining patterns have changed. Our restaurant has been located in a city center of a very small city. We're the capital of North Carolina, and we're surrounded by government buildings and law offices, a lot of tech companies, architects, small firms of that nature. We relied on presence in that aura. People would come to lunch, and whether they ate with us or not, they were aware that we were there. Those are mostly professional white collar workers. Well, they didn't work downtown anymore, and they discovered new eating habits. They cooked more at home. They got food from CSAs, farmers, which is awesome. They've discovered their neighborhood restaurants, and they just approached dining out differently. And they didn't maybe want to make a trek downtown and struggle to find parking and navigate construction that has been ongoing. Construction has not slowed down from my perspective. In fact, things take longer to build. And I know this because we're building out a space right now for our new project. So the project starts, and then you wait 2 months for an electrical a little breaker switch or whatever, 2 months, or for a meter base, which are just nowhere to be found, or copper, or whatever it is. So we're not the only downtown that has a lot of construction just sort of dragging on and on. And that doesn't really invite people to come to your restaurant, right? I go to Nashville and I see the streets are dug up for years, and there's a restaurant right behind that. It's very easy for people to say, let's just go somewhere else. And they discover a new spot and they go there, and there are a lot of options when it comes to dining out and dinner and how you approach your food for your family and for yourself. So we're very cognizant of that. And that's a very mercurial kind of situation. And during the pandemic, all restaurants, I think, were faced with decisions on how to pivot, the P word that keeps rearing its head. And so we all tried things that were completely outside of our normal way of operating. Fine dining restaurants started doing meal kits and takeout. And so you could get, maybe you were mailing something from Goldbelly. So we're doing things that are completely different for us. We're not built out for these kind of operations, but we did them. And so you start thinking about different ways to operate, and the consumer is kind of connecting with you in a different way. So things are still very much in flux. I don't think that we've settled into what an independent restaurant looks like and what this industry looks like. And I don't think that we're going to get there for another 3 to 4 years. But in this meantime, people who have 1 or 2 shops can't really sustain this much change and these many losses for that long. If I had 100 shops, making a very small profit or very small loss, you're it's an aggregate. You're looking at the health of your total business. But for us, several weeks or several months of, what are pretty big losses for us, very difficult to navigate. So we're trying to, within our footprint, within the menu that we are known for, within the type of service that we do, the way our dining room operates, how many people we need to work in the kitchen, how many people we need to prep, how many people we need to get a guest from the door to, the table, and then what happens after they place their order, and all of those little steps. Restaurants are basically dependent on a series of repetitive steps, and all of those are very time sensitive. There's no malleability, there's no work from home, there's no take your time. Because if the guest has a bad experience, you'll lost them forever, right? And if you don't know that that's happening, because as an owner operator, you're also working, you're no longer just overseeing. You're washing dishes and you're cooking and you're prepping and hosting and bartending. And my husband and I have done all of these things many times over the last 2 years. You're going to miss those details, and that all these little cuts cut down your business, and they cut down the level in which you really want to be operating at, and that the guests, expect. And that's not to say that I think we did a really good job, but it's exhausting. We're two people, we're a family operation, and places like ours, our staffing situation has been just like Mr. Henning alluded. It's always a difficult industry to staff, but now it feels impossible sometimes. I do feel like it's getting a little bit better, but we've lost a lot of our young people who we might have considered as career hospitalitarians. They maybe want to get a job in tech sales or go back to school or maybe become a nurse. That would be an ideal way to go, but we can't really compete with those kind of benefits. We can't compete with not working at night. We can't compete with work from home. We can only offer so much paid time off. And that demand gets sucked in by, or, completely obliterated by people getting COVID. And, so from the start of the pandemic until this May of 2022, we had maybe 3 people with COVID. And between May and August, probably 80% of our staff had COVID at one point or another, myself included. And we are very careful. We test all the time, we mask and everything. So, the way the pandemic is affecting day-to-day life isn't as data-driven as it is now. It's just a reality, right? So if a cook is out for 7 to 10 days, in 2019, that would be like, you can't do that. That's unheard of. Like, what do you have? The measles? Like, what? That never happened. But now we have to sort of think about how many people we need with those contingencies built in. But yet the cost of each person's hourly wage is, 15, 20% higher. Our revenue is unpredictable because of the way our demographic in our part of the city is. And if there's a variant that was raging, that was more of an issue maybe last year when it was. Now it's just everybody gets COVID all the time, it seems like. So it's not this like wildfire that, ebbs and flows, but we've had to sustain the losses throughout that time. So, so we have our labor costs going up. And then, your question, Chairman Powell, was, can you pass that increased cost down to the customer? Well, we're the customer. We're the end game. And we can only raise our prices so much. So, when you go to a restaurant, everybody goes to a restaurant and they see a chicken dish or a pasta, an entree that maybe previously in a nice restaurant was $28. Well, now it's maybe $34, but you're not going to pay $45 for it. You're just going to say, that's insane. I can make that at home. And, you think you can. Some things you can, and some things it may not be quite as good, but it's still dinner, and you'll survive. So there's sort of this like we reach a ceiling of not being able to have anywhere to push those costs for us down. So we see fuel surcharges on our invoices from deliveries. And again, as an independent restaurant, I'm a chef operator. I make creative decisions anyway about how I cook, what I put on my menu. I work with a lot of small farmers, but they're leaving too. They're getting tech jobs and web design jobs because it's hard for them to find somebody to help harvest their crops and bring them to us. It's a small operation. So yeah, I mean, I'm not sure if that directly answers exactly your question, but there are so many factors that go into a very simple decision on where am I going to have dinner tonight, and it's everything from your location, what happens in your neighborhood, where do you live, what's around you, how much are you prioritizing, supporting local. Are you feeding a family, or are you a young couple with disposable income? Who is able to operate? Is the restaurant that you normally go to able to have all of their sections open, or did 4 of the 7 servers that they have call out today, and so you still have to open, but you can only sacrifice so much of what you can and can't do. You can't say, hi, welcome to our restaurant, we have 3 of the 9 items from this first section available today, and 2 of the entrees are available. I'm so sorry. You'd be like, what is this? Like, I'm never coming back here. But in reality, I wish we could do that, because sometimes you just really have to say, can we open or not?
Well, thank you so much for your excellent answer to the first question. It was so good. You answered my second question, which was about inflation. So if there's anything you would like to talk a little bit more about, you talked about wage inflation, but the input inflation, you talked about how you can't pass it along. Are there other concerns? And I would like to open it up to my colleagues too.
I have a quick thing to add. I think real estate is such an important component of small brick and mortar places. Real estate has been thriving and growing and booming, and that's great. But developments are happening everywhere in every city in the country, and the starting rent is a certain amount. So as in previous times, 30% of your revenue food costs, 30% labor, and then you have your operating expenses, blah blah blah. Now labor is hovering around 48, 50%. Your food costs have gone up to 35. So there's 75% credit card processing fees keep going up 3.5 to 4% off the top. Rent is now, where does it fit? After a point, you get to 100% and you haven't paid all your bills. So now you're operating at a loss. So, for us, we were fortunate enough to be able to buy a building, and that kind of changes everything. But we're lucky, we utilized an SBA program and worked with a local bank, and we've been in business for a dozen years. We have a presence in our city, but that's not the case for everybody, and that's not accessible for everybody. So rent going up and everything else going up, and the ability of a small independent restaurateur who has a dream and a vision and really wants to invest in their neighborhood, they may or may not be able to do that in the future.
Yeah. So thank you for that presentation. Just have a quick question. You said that this was a performance space and restaurant. Most of the conditions you talked about had to do with the restaurant business. Are the conditions the same it seems like they would even be worse during COVID for a performance space?
They absolutely are. We never actually reopened the performance space once the pandemic hit. And our space is very small. It's 250 people. So, it just wasn't safe for so long. All the touring bands canceled their tours. And because we're a small space, we really book small bands, and they're either on their way up or on their way down. That's where we get them. So, it's expensive to tour. Gas is up, hotels are expensive. It's maybe not safe. Your record came out, you're not selling records anymore. Everything is digital. So all of that math has changed. Maybe people have gone to see their favorite band in an amphitheater. That math is totally different. So small performance venues, that's really hard. You can't really sustain that kind of business 365 days a year with local bands. We just can't do it.
Governor Jefferson has a.
Thank you so much for your presentation. I have a question around your strategy towards your workforce.
Mhm.
You mentioned that you had a team in your prior business that's closed down, and now you're transitioning to a new project. Is your strategy to try to retain those workers that you're familiar with, such that if we're thinking about the economic impact, there's some possibility that those people might be redeployed in your context? Or is what you're doing now so different that it really is the case that these are workers that were released into the economy, they have to find other engagements and things of that sort?
It's a little bit of both. We did retain some folks for a really long time. I mean, we've had some staff that was with us for 6 years, but then most of them were in the last 9 months. We offered 2 week severance to everybody, that we paid after we closed. We offered, an open door. Please come back and work with us when we reopen, we have a couple of people that we retain and going to pay through this transition. So, it would be a very different situation, and the timeline and how all of that worked would be different if I didn't know, and that most of my team could go and get another job. And in fact, I really helped place a lot of people with a new job with restaurants that I like and that I know, operate with integrity and pay their staff well and treat their staff well. If it had been a different time, we probably would have, said we're closing in 2 months, and it would have been a lot slower. But I know that most people can find a job very easily. But even still, we gave them enough time to find that work, be paid, and then help them find another position.
Thank you.
You're welcome. Thanks, everyone, for all of your excellent questions. We'll move on to our third panelist, Jess Pettit. Jess is a Senior Vice President of Commercial Strategy, Insights, and Analytics at Hilton, a leading global hospitality company with a portfolio of 18 brands comprising 7,000 properties and 1.1 million rooms in 122 countries and territories. It's a pretty big role. So in your role at Hilton, Jess delivers customer performance and economic insights to Hilton's leadership teams and partners. Jess leads the only fully cross-functional global analytics team in the hospitality industry, covering brands, digital, call center, new hotel development, and other key corporate disciplines. Jess is a born and raised hotelier and has committed his career to his passion, the impact that hospitality has on society. So Jess, we'd like to hear a little bit about how this past summer has impacted your business and hotel occupancy rates compared to during the pandemic. And then where were those customers coming from? Was it for recreation, business, conferences?
First off, thanks for the opportunity to be here. It's truly a privilege, and thank you for all you all do on behalf of all of us. It's an interesting dichotomy between Chidi and I, and the large and small business. Although I'd say many of the same dynamics exist in what we're seeing from a hospitality industry perspective. And I struggle to imagine an industry that was dealt as difficult to blow during the pandemic. 80% down plus in the depths of it, and it's been a challenge, but also I think at least on the positive side for hospitality on our end. Starting to see that real recovery, and it starts with leisure travel. To your question, over the course of this summer, but also last summer, our industry shifted much more towards a leisure focus. It ties very closely towards disposable income, stimulus. Folks had more money to spend on travel. So complete opposite of 2020. The dynamic in 2021 summer and 2022 was this concept of revenge travel, right? You had not seen your families, you haven't seen your friends, you haven't been able to go to the national parks or see much of the country. And so revenge travel was a very real thing for us. And we see that dynamic in leisure markets, so beach markets, Southeast US. You see that dynamic in national park markets. You see it in long weekends. The holidays, we become much more compressed from a business demand perspective. And so over the course of the summer, we saw our demand from leisure travel, so when you account for all seasonality and all the other noise, up 10% versus 2019, right? And that's overall from an industry perspective, which is great. But then you realize that there's another 50 or 60% of our business, which comes from business travel and group travel, right? And in order for our industry to truly have the compression it needs to be successful for our independent owners, is you need all three parts of that three-legged stool to truly be successful. So what have we seen over the course of this summer, right? So leisure was doing very well. We started to see the initial signs of corporate travel coming back. Starting the beginning of this year, corporate travel was down closer to 25, 30%. Now through the summer, we're getting closer to that 10% down range from a demand perspective. Group travel, obviously, for all the reasons you talk about events, all the reasons that group was the most depressed from a demand perspective, we saw that in our industry, down roughly 35% in the beginning of the year. By the end of the year, we expect that full year number to be closer to 15, 16% down from an industry perspective. So you're seeing the recovery, and it's very much as we would have predicted it back in April of 2020. We built our first models, and we said the first thing that was going to be coming back was essential travel, what Tom talked about earlier, the folks that we needed to travel across the country. Then we saw leisure travel, small businesses which needed to travel in order to be successful. And we saw a bit of an air pocket there before we saw large companies coming back and then finally larger groups. I think the other dynamic we see, and I often use this story from my own experience, weddings and events, right? We went from nobody being able to do that in 2020. Meant to get married in 2020, first in June, then in September, then in June of 2021, and then finally in September of 2021. And the dynamic you see is there's compression, right? Everybody had that same experience. So I went from a Saturday at one venue to a Sunday at another, right? And so that's a very similar sort of pattern that we've seen cutting across. Yeah. yes, yeah. I think maybe revenge babies as well. Which, yes, I have a 10-week-old at home now. Hopefully he's awake watching this. So yeah, we've seen some of those dynamics from the rest of the market come back. And so it's not just been about leisure periods. As we get into September, we're seeing some signs of life in all segments. But by the end of the year, we're still going to be down overall demand for our industry around 5%. And that's when you take into account leisure up 10, and then everything else a little bit lower. And so what does that mean? I'll jump a little bit to how that impacts price, right? Because we similarly are downstream from a price perspective, right? We're impacted by labor, we're impacted by food costs, a variety of other supply chain related things. When we look at our price on a year-over-year basis, I'm sure folks see it if they're traveling, you could see prices that are up 20, 25%. On the whole, our industry forecast prices are around 15% up year over year. But when you account for inflation over a 3-year period, so comparing to 2019, our real average daily rate, we're still lagging 2019 levels. And it's really because of that lack of compression from all of the market segments coming back together, right? And so I think that's going to be the interesting thing to watch as we hopefully see demand reach levels across all customer segments, then price would follow in a similar way.
Do you think that the pandemic experience has reshaped the way the industry operates?
Yeah, and so I think a couple things that I would talk about there, and it kind of alludes also to the last question. There is a tale of two cities, right? And it's interesting because you see resort markets, drive-in destinations, they have been doing quite well. Extended stay hotels have done really well. Again, Tom's market and other markets like that they've really supported extended stay travel. What we haven't seen is really the return to urban markets and large conventions, right? Those are the lifeblood of major cities, right? And so we're starting to see that recovery, right? But there's obviously pandemic risks and other things that folks have been considering. We need that overall return to desire of travel. And so we're starting to see that come back. And so Las Vegas and Orlando, we're starting to see that sort of turn back up. Markets like San Francisco, Chicago, New York, not as much, right? And San Francisco, obviously much more dependent on the tech market, which has been quite, different than the rest of the overall business community. So we're seeing a little bit of that. I like to think about sort of where do we want to get back to normal versus what's going to be a new normal that we expect, right? Back to normal is return to normal segmentation. Folks are able to have their social weddings and events, get back to regular meetings, normal travel patterns, right? The students being back in school matter to us, right? Because people tend to follow the school vacation schedules. So as we see that come back to some form of normalcy, we're starting to see normal travel patterns come back. From a new normal perspective, there's a couple things, right? We're seeing the emergence of what we call workations, right? The idea that people can work from anywhere, right? So I'm not sure if that's the case for you guys, but in many cases, folks are saying, hey, I can not be in the office for a week. And what we used to call leisure travel, right? I had a conference in Las Vegas. I'm going to stay there for a couple of days and stay over for the weekend and all that, is actually something broader, right? That we start to see some return to a new customer dynamic where they want to have a larger room and stay in a place that they can, work during the day and, connected to the internet and all that good stuff. But then at night, they can do all the things they wouldn't have been able to do otherwise. Doesn't impact all customer segments. Obviously, those with families still have to follow regular school schedules. Hybrid meetings are interesting, right? I understand you guys were doing this in a remote fashion, right? We need folks to get together like this. We're not sure what the future of a meeting like this, where half the table's over television and half is in the room. That's an emerging potential trend that we're going to all have to figure out, right? Everybody's been on conference calls where it's extremely uncomfortable, where you're the one who's not in the room and everybody else is. So we've got to figure that out, but that will lead to some sort of new normal. And then the last thing I'll just call out on the sort of new normal is emphasis on digital tools, right? So for us, that's, folks were trying to skip the front desk, right? That there's a little bit of a different model in how you engage with people in a COVID type world, which means you want your key on your phone, whether you're flying or you're in a hotel room. So we've had a heavy emphasis on that in our business, but we're seeing that as sort of a change in customer dynamics, which undoubtedly could shift sort of the labor model where hopefully team members are able to focus more on service as opposed to transactions. Transactions can be handled more digitally. And then just touching on labor, similarly, as Judy said, our industry has been hit dramatically from a labor perspective. We're still 400,000 jobs less than where we were from an accommodation sector. We see it in all of our hotels. And when you think a demand environment where on the weekends you're busy and during the week you're not, right? That's a difficult thing to labor schedule around, right? And you don't get the consistency of scheduling that our team members demand and expect. We're also seeing, the inflation of wages in our industry broadly double what is the broader wage inflation. So typically in the 12+% range, we've seen across sectors and across regions in the U.S. So we're seeing some shifts in dynamics from that perspective.
Governor Cook has a question.
Yeah, please.
The data thank you for the presentation. The data that you're presenting are for the U.S. or are they global?
U.S.
Okay.
Yeah, although we see similar trends. I mean, it's such that it interests you. We do see similar trends outside the U.S. One interesting dynamic is, take Europe as an example. It's so much more dependent on cross-border travel, right? And so obviously that was more depressed when cross-border travel was more of a challenge. Here we didn't have as much of that. But major U.S. cities, right, the lack of international travel into New York or San Francisco has certainly played an impact on demand.
And taste preferences?
I'm sorry?
Taste preferences, same kind of thing?
Yes.
Sort of.
Yeah, generally we see that. I mean, focus on the U.S. from a customer perspective, but yeah, we see those sort of trends. I would say obviously there are countries where it is quite different. China obviously is a different sort of customer environment, but yeah.
I think Mr. Brainerd had a question.
Yeah, I just wanted to follow up on the labor question. So, if you look at where employment is actually down relative to pre-pandemic, 1.4 million in in-person services, it's heavily in leisure and hospitality in your sector. Is that because people aren't coming back to that sector, or is it because your demand is down and so you're not demanding the same level of employees?
It's undoubtedly a mixture of all things, right? And as somebody who grew up working in hotels and is passionate about that sort of service economy that we had, it's in some ways can be less enticing of a job. in a COVID type world, right? Essentially they were essential workers having to be face to face in ways that, us in corporate office world, we're not necessarily having to do. So I think there's an element of that, which is, we need sort of a mind shift back to where we were and the value in face to face experiences. When I think about what we're trying to do from an employment perspective, it's hard to get people to come back to work. So I think it's a little less of the our demand isn't requiring as many folks coming back. I mean, right now, as I said, we're close to 5% down from a demand perspective, so not massively for that level of job displacement.
So
Thank
can
you.
I ask just a related question? So recently I was talking with a large firm in leisure hospitality. They were talking related to what Governor Brainerd just said, that their turnover rates, job turnover rates had doubled than pre-pandemic, that even when you can get workers, you can't keep them. Is that something you're seeing in all these
I'm
areas?
sure we would see something very similar. We're all competing for the same subset of folks, that it's a smaller pie that we're all competing for, right? So you see certain places where folks are putting out big bonuses to try to convince people to come their direction. And we have to all, go back and forth. And so, the pie of workers in our industry broadly is just not wide enough.
So regardless of what we do for demand, you're still going to have demand for labor.
Yeah, I think, that's the case.
Well, Just thank you so much and congratulations. We hope you're getting some sleep. So, I appreciate you being here with us. Our fourth panelist is Kara Walton. She's a director at Harbor Results, which is based in Southfield, Michigan. Kara leads the company's manufacturing intelligence business, which collects and analyzes millions of data points from thousands of manufacturing companies in North America. Harbor Results collects data from more than 600 privately held small and medium-sized manufacturers each year. Kara and the team at Harbor Results utilize these data and information to help small to medium-sized manufacturers improve their competitiveness in the marketplace. Kara also studies economic, business, trade, and tariff trends impacting the manufacturing industry, and she consults with clients on their business impacts. So Kara, thank you so much for being with us today. Can you help us understand what your most pressing concerns are for the small and medium-sized manufacturing businesses that you work with?
Yeah, absolutely. First off, thank you, everyone. It's an honor to be here. I really do appreciate it. As you said, right, we work with the small and medium-sized manufacturing base. We're also a small business. We have about 15 people total on staff, so we're quite small. But beyond working with those small to medium-sized individuals, generally they're all less than $500 million. Some of them are $5 million companies in a year, and some are 700, right? But generally speaking, they're under that range. We did the math in our organization to give all of you a sense. It's about $30 billion in an annual year. That was incorrect. And it's $30 billion annually in terms of total output that they're putting out in the market. So to give you a sense of what they're looking at, they're privately held. They're not consumer facing. So they're supplying to a tier one or to an automaker or an appliance maker. And they're generally not unionized. So these are they're small and they're family owned, right? Sometimes we have second and third generation leaders. Our team took some time to kind of come up with an answer to this question, and we broke it into two core facets. Their biggest challenge from our perspective is labor. And we'll talk about that one a little bit. And then their second biggest challenge is the ability to make money. So if I could start with the labor piece, frankly, there are many facets to it, all of which I cannot answer here, or else we might be here for a while, as I'm sure similar to you guys. But I'll do my best to give you a high level explanation. So the number one core challenge that our people have is that they can't find people, number one, and more specifically, they can't keep them. So in some cases, they are absolutely getting people into the door, and then they're not sticking around. This goes far beyond production workers. So I absolutely do have clients who have challenges where, frankly, sometimes Starbucks, or we're in Michigan, so the Tim Hortons or something like that will say, we'll give you $1,000 signing bonus. We absolutely have companies who are losing employees to that, but it's also a skilled labor challenge. So we're lacking skilled labor, we're lacking people willing to even go into apprenticeship programs, and we're lacking office staff. One of the things that you guys talked about was that you don't have the ability to do work from home, nor do these people. At the end of the day, they have to make pieces and parts. So they don't have that capability similar to a tech world either. I want to be clear about one thing as we kind of talk about the labor challenge. At our core as a business, we focus on making sure that the only answer isn't adding people. We want our businesses to be efficient and to be productive, but they truly can't even find enough people to be efficient today, which is the big problem. Anecdotally, I was talking to a plastics processor this morning that hired 14 people last week. 3 of them showed up this past Monday. 1 of them left at lunch. So, and this is not the only person who says this, right? I hear these stories and our team hears these stories all the time. So one of the things that we really see, right, is despite all of these businesses offering really high paying jobs and offering career development tracks and they're paying really big bills to train these people, right? They say, hey, come in with no experience. I'll make you a tool and die maker. I'll make you a process tech or whatever it is. They're not able to even find the people willing to go in to take that level of education. And what we see happening when we look at the data is that a lot of our manufacturing clients stopped hiring during the Great Recession because, frankly, you guys know better than I do, their businesses were quite challenged. So they stopped hiring at that point in time when a lot of millennials were graduating out of college. And frankly, that gap is really rearing its head today. Not only do we have an average age of an owner, right? The average age of an owner is over 60. We have an average age in workforce overall. We don't have succession plans, not for key leaders or for other areas of the business, right? So if I have a production manager who's in his late 60s and says, hey, I want to retire in the next 4 years, there's no one there that's even considering being the next person to be that production manager. You lose a production manager, your facility doesn't run. So beyond that, right, what we're really watching in our bottom line is that it's costing these guys a lot of money. And what they're starting to tell us and what the data is starting to show us is they're choosing not to grow their businesses, which is a big challenge, right? So they're saying, hey, I'm not going to take on more revenue because I don't have the people to do the work. Or in some cases, they're even saying, I'm going to shrink my business, which brings me to my second point, their other biggest challenge, which is they can't make money at the rate that they used to be able to. You said there's a lot of compounding issues and everything. There's a lot of compounding issues in this one as well. But some of the core pieces of it that we're seeing is that despite these businesses increasing their efficiency levels, so they're absolutely doing better from an efficiency and throughput perspective, they're not making more money. So when we look at their actual profit margins, they're not going up. They're frankly going down quite substantially. It's due to a lot of different reasons. One of them is the labor piece, which we talked about, so I won't go into too much more detail there. The other piece is this overall cost of doing business. So it's everything from energy prices, it's transportation costs. The rail strike was a really big, or potential rail strike, was a very big challenge to these individuals. Healthcare costs, and everything from temp agency upcharges, right? So when somebody's trying to get temp labor in the door, it's 30 to 40% higher than it used to be. Interest rates on loans is a big one. Most of these companies do not have cash. They're privately held, but they all use lines of credit. So that's really impacting them as well. The other piece that's preventing them from being able to make money, at least consistently, is they had a lot of PPP or ERC funding, just depending on the type of business. Most of them did get that because they are privately held and small. Some of them used it better than others, right? Some of them used it as a lifeline and frankly just delayed some of the challenges that they were feeling before COVID even took its toll. And now that that money's dried up, they're feeling those same challenges again. My final piece on kind of their challenges from a financial perspective, which is potentially the most challenging to quantify, but I did my best to put it into numbers, is this increased chaos that they felt over the last 24 months is really preventing them from being able to make money. So the best way I can kind of articulate that to you is that most of the customers and companies that I work with don't know their customer demand. They don't know the schedule on their shop floor. They frankly don't even know who's going to show up to work in a given week, and in some cases in a given day. I mean, there were periods of time in 2020 where we would talk with customers who would say, I got into work today and 8 things changed between 7 and 8 a.m., right? So they don't know how to do this. At the end of the day, what that's doing is that's driving up massive amounts of transactional waste. It costs a lot of money to hire someone, even if they never show up. It still costs money to get them and process them and give them healthcare and all of that. Additionally, it's tying up a lot of money in inventory. So we've seen massive shifts in inventory right now. And the final thing is that it's really costing them way more cash than it ever did before. So their ability to have any flexibility in terms of how they spend their money and how they make money is gone. And at the end of the day, right, this is a massive group of people. They're not all the same, but the viability of many of these businesses long-term is really concerning to us.
Those are very difficult challenges that you're dealing with. Could you give us some perspective on how supply chain issues are continuing to impact your business?
Yeah, absolutely. So I will flip to the final page of the notes. So from more of a supply chain perspective, we are based in Southfield in Detroit, Michigan. So we do work a lot in the automotive space, but we also work in others. I personally came out of the appliance arena, so we work across most of them. A lot of the challenges today seem to be around semiconductors. That's a big thing that seems to get picked up a lot in the press. It is absolutely an issue. I'm not going to belittle it. But there are a lot more problems than just semiconductors. To speak on the semiconductor one just for a second, some of the core challenges that we're seeing is not only does automotive need semiconductors, but your refrigerator needs semiconductors. There is like a new PlayStation that came out last year, and that needs semiconductors. A lot of people talked about it. PlayStation and Xbox are confusing to me, but either way. So that was demanding microchips, all of these different things. So automotive companies can get them, which means that this whole demand problem that our customers are facing, they have no way to plan when they're going to get chips in order to put them into the parts that they're ultimately supplying. The other piece on the semiconductors, just real quick, is that when you think about an electric vehicle coming into play, they require at least 30% more, sometimes even more than that, than an internal combustion engine does. So if we adopt more electric vehicles, we're demanding more semiconductors than we ever have before. But beyond the semiconductor challenges, probably some of the more concerning things to me and maybe less easier to solve challenges from a supply chain perspective are centered around things like transportation and freight, which all of you talked about in different arenas. But a lot of that applies to things much more than automotive as well, right? So you talked about the agriculture business. We work with companies who can't get washers and bolts to make trailers to hitch on the back of their F-150s to get whatever they need to get, wherever they need to get it, right? The other big supply chain challenge that we don't really see a light at the end of the tunnel for is natural disasters. You talked about it from an agriculture perspective. There's a lot of impact to that on the resin and steel markets as well. The resin market specifically, there are certain types of resin that ultimately allow you to make your dashboard or make some of the plastic that we probably have in this room right now. The capability for them to get that resin even before the most recent round of natural disasters occurred, some of the major freezes that happened last year, it was already in force majeure. So these companies were already taking the time to go, we need this because it's a crisis. And then it got worse, right? And that had nothing to do with any of the port challenges or any of the difficulty getting a bolt out of China or somewhere else. So that was one of the big pieces on the supply chain front. I guess to bottom line it for you guys, at least if I could, in terms of what we're seeing from the supply chain piece of it, automotive specifically historically has been a 17 million a year sales volume in the US. This year we're forecasted to do about 14 million units. If you look at the OEMs, which are publicly traded companies, unlike my customers, they're making money and they're doing quite well. They have their challenges, as do all businesses. They don't necessarily have a reason to go back up to 17 million units based off what we see today. The reason why I bring that up is because this means that we have a lot of people who are supplying to them who are dealing with a much higher mix because everyone wants something different in their car today or different in their appliance. And we're dealing with a much lower volume. So at the end of the day, what that does is that increases the complexity for everybody that we work with. And then within that, what that does is that makes them really challenged to manage all of the supply chain pieces that we talked about. And at the end of the day, they're focused on this week, am I going to run out of cash or am I going to shut down my supplier's line, right? So, I mean, these are the kinds of decisions that these companies are facing. So I don't know if that fully answers it, but that's where we're at.
Fantastic. I'd like to open it for anyone.
Yeah, so I'm just curious if these firms, it sounds like some of them have more demand than they can handle. So if there's a downturn in the economy, how are they going to manage it?
Yeah, so they absolutely have more demand that they can handle. From an inventory perspective, we're still well below it. We saw demand on average for them go up nearly 30% between 2020 and 2021. It's plateaued a little bit, but it's still relatively high. In terms of that demand lowering, I frankly think some of them would be, I'm not going to say pleased, but would be relieved by that. Because the intention of that demand lowering would mean, hey, maybe a couple of my 20, 30, 40 open positions I no longer need to hire for. Maybe I can take a breath to actually manage my business and focus on continuous improvement. Obviously, we don't want demand to shrink too terribly much. But what I will tell you, and at least in automotive specifically, is there's pretty hefty demand planned from a tooling and new product perspective. So we have a lot of new vehicles coming out in the market in the next couple of years. It's really positive. So we absolutely have the demand to do so. The challenge is if they're able to run their businesses to still make money, even when the demand is still there. Does that help answer?
Yeah, actually it does.
I have two questions about the long run. In my previous life, I was a professor at Michigan State, so had students from Michigan. And in my senior seminar on the current state of the economy, and I taught it for about 15 years or so, the last time I taught it was 2019. And the question that I posed at the beginning of the semester is, do you think you're better off than your parents were at this age? And for the first time in 2019, students said, post Great Recession, they said that they thought that they were better off because they had interesting jobs that their parents had to work on the line, and that they thought these were boring jobs. So, people don't want to show up for tool and die jobs. My students' reaction would be, that's boring. That's not the Apple Store. So that seems long term. That seems structural. So how do you address that? I mean, how do your businesses say that they would address something like that? How do you make manufacturing sexy?
Yeah, that's the end all question that we face almost every day with our businesses. It's very challenging to make manufacturing sexy. I'll tell you that. I would tell you that if you go into the average manufacturing facility, there are floors that I would eat off of. I mean, there are impeccable facilities in this country. They're beautifully maintained. Everything from, yes, OEMs and tier ones, very large companies are doing a great job. But I walk into $10 million plants that are beautiful, have state-of-the-art equipment. You've got 20-somethings working on $1 million machines and coding that never got a 4-year degree, but went to an apprenticeship program and are doing really cool stuff. The biggest challenge we have is encouraging more people to do that. The only way that we found success so far, at least our clients have, is they've focused on actually talking to the parents at very young ages. So starting in like elementary and middle school about the benefits and the career development opportunities in manufacturing that don't require a 4-year degree. I have a 4-year degree. I know many people here have a lot more than one 4-year degree. So I understand the benefits of higher education, but it doesn't mean that everyone needs it. So we're focused very strong on trying to encourage people to go into manufacturing because I'm a nerd for it, but it's really cool.
So I have just a quick question, and this is a longer term question too. So to what extent, because of these labor demand challenges, to what extent have businesses adopted automation to fill the labor demand?
Yeah, they absolutely focus on automation pretty clearly all the time. I was at, you spoke about big conferences. I was at the International Manufacturing Technology Show in Chicago a couple weeks ago, actually very well attended. So that was positive. I stayed at a Marriott. I'm sorry about that. But either way, we were at that show and the core focus was on automation. So it's everything from automation within a machining cell. So if you're cutting a piece of steel, they're really focused on how do I have multiple pallets to make sure that I can do things without people, right? How can I run this machine for 24 hours and then have some guy sitting at home on his cell phone being able to monitor it? Because they have that technology today. Every machine monitoring company will give you an app on your phone. So they're focused quite a bit on that piece of it. There's also a lot of automation in terms of lifting and material handling, and even in terms of some of the warehousing pieces of it as well. So how do I get a machine to wrap a box? And how do I get, frankly, any automation to do what even in manufacturing we may call the less intriguing jobs, so that we can have people actually making parts and actually designing and actually checking quality and doing the things that are, what I'll say, more fun than packaging a box of parts, right? We have, at this point, automation that can do that.
I just had a quick question. I think Chris and I are kind of going in the same direction on these questions, and I'll ask it to you, but anybody else can jump in. So in a normal economy, if demand softens a lot, first thing businesses do, they often will lay off workers. This seems like an unusual economy where businesses have been scrambling to get workers for so long. If demand softens, do you think they would respond differently this time in terms of those workforces, or do you think they just would do the kind of usual playbook in terms of trying to shrink costs?
Right. Yeah. It probably depends on the business a bit. Obviously, everyone's different, and I don't know all of them, but I do think they would approach it differently. I think one of the things that, at least in our space, they may consider doing is looking more closely at who is it that may actually be close to retirement age anyway, that we could help them, and now they maybe feel comfort to be able to leave the workforce. And then how do we get that tribal knowledge out of that individual before they leave, right? The big thing with our workforce is going to be that the people who may necessarily want to leave the workforce at some point in time, they have all of the knowledge on how to do everything, every average good that we see in this country, right? There's some guy sitting in an office that's a tool maker that knows exactly how to manufacture that part. I don't think they would do massive rounds of layoffs, but I do think they would potentially strategically say, hey, frankly, let's rank our A, B, and C players, right? Who adds the most value in our business and who are we hiring because we were just really desperate for people in this massive demand surge. And they may choose to let go of some of those individuals. But that would always for them be non-skilled labor. I can't see any circumstance where they would get rid of skilled labor and would probably not be a critical mass of their workforce for the most part, at least in the privately held businesses I work with. I can't speak as much for the publicly traded guys.
Thanks, everyone. Thank you so much to all of our first panel and our panelists, Tom, Chidi, Jess, Kara. All the information that you've provided and shared with us today really just helps us better understand the data that we look at here at the Federal Reserve. So now we'll take a quick break. We'll come back in about 10 minutes, and Vice Chair Brainerd will chair our second panel. So thanks, everyone.
Thank you.
Thank you.
Really interesting.
Thank you.
Thanks for your time.